Brad Williams, Frugal Finance, measuring return on investments. Previously, we built a path for establishing cost of equity, debt, and capital, and presented an argument that the cost of capital is the minimum acceptable hurdle rate when considering new investments. We also argue that an investment has to earn a return greater than this hurdle rate to create value for the owners of a business. In this session, we turn to the question of how to measure the return on a project. In doing so, we will attempt to answer the following questions. What is a project? Specifically, what are the various investment decisions that firms must make, and how broad is the definition of an investment? Which should we consider when calculating a project's return on investment, the project's cash flow or the accounting earnings? If the returns on a project are unevenly spread out over time, how do we consider, or should we not consider, differences in return across time? And we will provide an overview of project analysis using two hypothetical projects: a door company for capital construction and a quick charge construction battery charge company for granite construction. What is a project? Project analysis concerns which projects a company should accept and which it should reject. Accordingly, the question of what makes up a project is central to this. The traditional project review in capital budgeting has three criteria: a large upfront cost, cash flows for a specific time period, and a salvage value at the end, which captures the value of the asset of the project when the project ends. Although such projects unquestionably form a substantial percentage of project decisions, particularly for construction companies, it would be foolish to think that project analysis stops there. If a project is defined more broadly to include any decisions that result in using the limited capital of a business, then everything from strategic decisions and acquisitions to decisions about which air conditioning system to install in a building would fit within its reach. Defined broadly, then, any of the following decisions would meet the requirements of a project: key plan decisions to enter new areas of business, such as granite construction's foray in the water business or capital construction into the retail door business, or new markets such as granite construction expansion in water-related construction. Acquisitions of other companies or projects as well, despite efforts to invent separate sets of rules for them. Decisions on new undertakings within existing businesses or markets, such as the one made by Granite Construction to wind down its specialty division or to expand its water division. Decisions that may alter the way existing divisions and projects are managed, including new federal construction grant programs or prevailing wage requirements at capital construction. Decisions on the best way to deliver an essential service for the business to function profitably. Perfect example would be Granite Construction's choice of what type of CAD system to buy to allow engineers and construction managers to do their job. Given the CAD system itself generally won't generate revenues and profits, it is an absolute must for other revenue generating projects. Salvage value, the projected cash value of the assets invested in the project at the end of the project life. Mutually exclusive projects. A set of projects is considered mutually exclusive when approving one of them while rejecting all the others. Project decisions can be placed into a number of categories. The first is how one project impacts other projects the company is considering and reviewing. Some projects are independent of other projects and therefore can be reviewed independently, whereas other projects are mutually exclusive. That is, taking one project will mean rejecting other projects. At the other extreme, some projects are linked to other projects down the road and others are complementary. In general, projects can be categorized as fitting somewhere on the scale between prerequisites and mutually exclusive. So here we have a prerequisite, complementary, independent, and mutually exclusive. The second measurement that can be drawn to identify a project is its ability to generate revenues or lower costs. What are we trying to figure out is if the earnings or cash flows from projects justify the capital contribution needed to move forward. When it comes to cost reduction projects, what we're trying to figure out is if the reduction in cost justifies the upfront capital contribution needed for the project. Hurdle rates for companies versus hurdle rates for projects. In the previous section, we developed a way to calculate the cost of equity and capital for companies. In this section, we will broaden this discussion to hurdle rates in the context of new or individual projects. using the company's hurdle rate for individual projects? Can we use the cost of equity and capital that we've calculated for the companies for these projects? In some cases we can, but only if all projects made by a company are similar in terms of their risk exposure. As a company's projects become more diverse, the company will no longer be able to use its cost of equity and capital to review these projects. Projects that are riskier have to be reviewed using a higher cost of equity and capital than projects that are safer. In this section, we consider how to estimate project costs of equity and capital. What would happen if a company elects to use a single, unchanging cost of equity and capital to review all projects? This company would find itself over-investing in risky projects and under-investing in safe projects. Over time, the company will become riskier as its safer businesses find themselves powerless to compete with riskier businesses. Cost of equity for projects. In estimating the beta for a project, we will look at three possible outcomes. The first outcome is the one where all the projects considered by a company are identical in their exposure to risk. This plain vanilla approach makes risk assessment simple. The second outcome is one where a company is in many businesses with broad exposure to risk, but projects within each business have the same risk exposure. The third outcome is the most challenging, where each project considered by a company has different risk exposure. Single business, project risk similar within business. When a company works in only a single type of business and all projects within that business share the same risk profile, the company can use its company cost of equity as the cost of equity for the project. Since we determined the cost of equity using a company beta previously, we can use the same beta to calculate the cost of equity for each project the company is currently reviewing. The benefit of this approach is that it does not require risk estimation prior to each project, providing managers with a fixed target for their project analysis. The approach is limited though because it can only be used for companies who work at a single line of business and take on the same type of project repeatedly. Multiple businesses with different risk profiles. Project risk similar within each business. When business operate in more than one line of business, the risk profiles are likely to be unique across different businesses, making the assumption that projects taken within each business have the same risk characteristics. We can calculate the cost of equity for each business individually and use that cost of equity for all projects within that business. Riskier businesses will have higher cost of equity than safer businesses, and projects taken by riskier business will have to pay these higher costs. Inserting the company's cost of equity on all projects and all businesses will lead to over-investing in risky businesses. Because the cost of equity will be set too low, and under-investing in safe businesses because the cost of equity will be set too high. How do we determine the cost of equity for individual businesses? When the evaluation requires using equity betas, we cannot use the traditional regression method in the CAPM because these methods require past prices. Instead, we have to use one of two methods that we described in the last section as substitutes to regression betas. Bottom-up beta based on other publicly traded company in the same business, or accounting betas calculated based on the accounting earnings for the division. Projects with different risk profiles, one could contend that each project's risk profile is, in fact, unique in that it is inappropriate to use either the company's cost of equity or divisional cost of equity to evaluate projects. Even though this may have some merit, we have to think of the trade-off. Given that small differences in the cost of equity should not make a meaningful difference in our project estimate, we need to judge if the additional benefits of reviewing each project individually is greater than the cost of doing so. When does it make sense to examine a project's risk independently? If a project is large in terms of its capital contribution requirements relative to the company's experience, and the project has a number of unusual risk characteristics, it would seem right to calculate the cost of equity for the project independently. The only sensible way of determining betas and cost of equity for individual projects is the bottom-up beta approach. Cost of debt for projects. In the previous section, we stated that the cost of debt for a company should explain its default risk. With individual projects, determining the default risk becomes much more complicated because projects seldom borrow on their own. Most companies borrow money for all of the projects that they undertake. There are ways to estimating Granite Construction's cost of debt for a project. One way is on the claim that since the borrowing is done by the company rather than by the individual projects, the cost of debt for a project should be the cost of debt for the company doing the project. This approach makes the most sense when the project being reviewed are small relative to the company taking them and thus have little or no noticeable effect on the company's default risk. Determine the project's ability to generate cash flows relative to its financing costs and calculate the default risk and cost of debt for the project. You can also calculate this default risk by looking at other companies in the same sector taking on similar projects and use the average default risk and cost of debt for these companies. This choice usually works when the project is large in terms of its capital needs relative to the company and has different cash flow characteristics, both in terms of size and volatility from other projects taken by the company, and can borrow money against its own cash flows. The third approach applies when a project actually borrows its own funds, with lenders having no recourse against the parent company in case the project defaults. This is unusual, but it can happen when projects have significant value of their own and the project is large relative to the company considering it. In this case, the cost of debt for the project can be determined based on the cash flows relative to its financing obligation. In the last section, we use the bond rating of a company to figure out the cost of debt for the company. Even though projects may not be rated, we still compute a rating for a project based on financial ratios, and this can be used to calculate the default risk and the cost of debt. Financing mix and cost of capital for projects, the cost of debt and equity must be weighed according to their respective financing proportions in order to get to the cost of capital. Again, the task is much easier at the company level where we can use the current market values of debt and equity to arrive at these weights. We may borrow money to fund a project, but it is often not clear whether we are using the debt capacity of the project or the company's debt capacity. The answer to this problem will again change depending on the conditions we face. When we're establishing the financing weights for small projects that do not involve a company's debt capacity, the financing weights should be those of the company before the project. When determining the financing weights of large projects with risk characteristics uncommon from that of the company, we have to be more careful. Employing the company's financing mix to determine the cost of capital for these projects can be wrong because the project being reviewed could be riskier than the company as a whole and thus unable of carrying the company debt ratio. In this case, we would press for the use of the average debt ratio of the other companies in the business in calculating the cost of capital for the project. When it comes to standalone projects big enough to issue their own debt, the financing weights ought to be determined by the amount that the project actually borrowed. The financing weights and debt costs associated with such projects for companies may vary. In summary, the cost of debt and debt ratio for a project will show the size of the project relative to the company and its risk profile. Again, relative to the company. Worksheet 311 summarizes our analysis. Project size, project is small and has cash flow characteristics similar to the company. Cost of debt, company's cost of debt. Debt ratio, company's debt ratio. Project is large and has cash flow characteristic different from the company. Cost of debt of comparable companies if non-recourse debt, or the company if backed by the company's creditworthiness. Debt ratio, average debt ratio of comparable companies. Standalone project, cost of debt for project based on actual or synthetic ratings. Debt ratio for project. Estimating the hurdle rates for individual projects. Under the estimation approach that we just laid out, we can calculate the hurdle rates for the projects that we were reviewing in this section. Capital Construction Door Company, because the beta and cost of equity that we calculated for Capital Construction as a company explains its status as a construction company, we will recalculate the beta for this retail door business by looking at publicly traded construction material retailers. The unlevered total beta for construction material retailers is 4.51. And we imagine that this project will be funded with the same mix of debt and equity. Debt to equity, 40.78%. Debt to capital, 15.53%. That capital construction uses in the rest of its business. We will imagine that capital construction's tax rate, 25%, pre-tax cost of debt, 4.301, apply to this project. Levered beta, 5.88. 451, 1 plus tax rate plus the debt to equity equals 5.88. Cost of equity, 1.25, the risk-free rate, 5.88, the beta, and 4.31, the equity risk premium equals 26.59. That's expensive money. That's really expensive money. And cost of capital, 26.59 times the debt to equity plus the cost of debt minus the after-tax risk, and then 0.592 is the debt ratio, equals 12.76. So you can see that cost of equity is rather challenging. This is much higher than the cost of capital we computed for capital construction previously, but it shows the higher risk of the retail venture. Brad Williams, Frugal Finance. Thanks for watching.